All right, John here. I
Oh
am.
no, I gotta hit OK on my side.
Oh, good. Okay, on your side.
All right, we're all set.
Guys, I'm here with John Chin. I'm excited to talk about Mission 3218. You all know John, investor agent. He goes around and speaks about creative financing all the time. And so, me as a lender, of course, I was super curious on how I could make that work in my world, what kind of services he provides with Mission 3218, and how it all kind of runs together and works together. So, John was kind enough to do a Q&A with us today. How you doing, John?
Good, man. I can
Good.
say that lenders aren't typically interested in helping people work themselves out of a job or a loan, but I know your heart's in a different place and you're just helping people get deals done. And you can help with the future refinance when they eventually refinance from the seller. So we'll talk about that here in a second. But
Yeah,
it's good of you as a
thank you.
lender slash mortgage broker to do that.
Thank you. Well, for me, at the end of the day, it's all about getting the deal done. And if I can't get it done myself, that doesn't mean I just want to throw it away and not get it done for all the parties involved. And since there are options through you and through Mission 3218, why wouldn't I want to partner with you and figure out a way for me to get the right people in front of you all so that those deals could get done? So let's talk a little bit about Mission 3218. What is it?
Good question. So Mission 3218 comes from the verse from Isaiah, which is 32 verse 18, which says, "My people will live in peaceful dwellings, in secure homes, in undisturbed places of rest." To me, that means home ownership. The problem is home ownership's tougher for a lot of people out there. It's also buying properties for cash flow as an investor is a lot tougher at today's rates and today's home prices. So Mission 3218 also is a nod to the 3,218 buyers and sellers we want to put together, the number of transactions we want to put together over the coming years, where we sideline the lenders to create better terms for buyers and sellers, to make homeownership more accessible, to make cash flows better, and payments smaller for buyers.
So how does it work? We'll talk about me being a lender in a little bit, but basically, how does it work? A buyer may not qualify or doesn't think they can qualify in traditional means, or maybe the terms aren't great. Explain a little bit about how what Mission 3218 can do for a buyer who comes to you, and then how you sort of negotiate that all with the seller.
Sure. So, if we turn the clock back, you saw a lot more owner financing years ago, especially when we had what double-digit interest rates back in the late 70s, early 80s. So now, if you fast forward, you don't see a lot of owner financing. In fact, if you look at 65,000 active listings we have on the MLS, on our Stellar MLS right now, less than 1% have owner financing as an option. I think that's for a couple different reasons. Mainly, it's because real estate agents aren't familiar with financing outside of a buyer just going to a bank to get a loan.
Right.
So if they're not familiar with it, even with paid off houses, you it's a great option for sellers who don't need all that equity right up front and want to net more money in total. But agents don't know how to explain the benefits and cover and talk about the protections that are in place and why it's actually a very safe and profitable thing for some sellers out there. So we definitely know it's underutilized because less than 1%, last time I checked, it was 514 active listings offered owner financing. There's another misconception that your property has to be paid off if you even can qualify to finance your property as a seller. And that's not the case either. So to answer your question, if a buyer comes along and either isn't mortgage ready or they just don't want to pay today's prevailing rates, for example, and they just want like temporary relief until the rates maybe drop and they can do a refinance with someone like you in the future, what we do is we structure the terms between a seller who wants to net more money, maybe doesn't want to take more price reductions to get their house sold, which is kind of the story today. A lot of property sitting on the market longer than before because we have twice as much supply this time compared to this time last year.
Yes.
So you have a lot of sellers that are more motivated to explore options. So if we can maintain a higher price, but they're flexible on their terms, then we can make it really attractive for buyers who maybe want to save three, four, five. I mean, in one particular deal was 1,000, about $1,100 a month.
Wow.
just an interest that they were saving,
Wow.
not to mention origination fees and that kind of thing. But you had said something too about a buyer that doesn't maybe qualify.
Hmm.
In half the cases, it's maybe a buyer who's not mortgage ready. In the other half of the cases, though, it's with buyers who just are mortgage ready. In fact, they're way overqualified,
Right.
but they don't have W-2 incomes, so it's not easy underwriting. They can get the same rate, if not better, from a seller. So why would they? They're saving money on origination fees up front, but they all have an intention at some point because the seller's not creating financing that lasts for 30 years in
Correct.
99% of the cases. So in almost all cases, they're looking at an eventual refi, whether it's 1 year, 2 years, 3, 5, 7, 10 years down the road. And that's where someone like you comes in, is they can help them with that new purchase loan later, because it's technically not even a refi, but that's kind of getting into the weeds a little bit. They actually get new purchase terms when they finance that seller out.
It's so interesting because anytime I've talked about it, because we've been talking about it for a long time, and I know what you do, and I've been to your presentations, your workshops. It's the education part, right? There's still this trepidation, and the trepidation comes from the fact that they're not educated enough.
Mm.
And that's okay, right? Because it's a scary world out there that we're all living in. And so you have to find the right person to partner with, or the right people, and they have to really understand what they're doing. Because there's so much misinformation out there, I believe, about seller financing and creative financing. When you say the word creative, people's minds immediately go to some crazy gray area you're almost stepping over.
That's funny that you say that, because we don't use the word creative financing when we're talking to agents and to sellers. When we're talking to agents and sellers, we just say owner financing.
Yeah,
And when you start talking creative, and they start thinking, and here's the thing about real estate agents, and rightfully so, it's just like attorneys. If an attorney sees something that they don't understand, a lot of times they won't explore. They'll just say no by default to save face or to protect their client, because that's safer than saying yes, doing the homework, and then potentially hurting the client. So if, ignorance usually breeds an automatic no, as opposed to somebody who wants to do some diligence and kind of figure out how this thing would work or potentially hurt their client, or even help their client. So the education element of what we do is probably 90% of my day, whether it's talking to a seller, the listing agent, the buyer, the buyer's agent. Sometimes we're educating buyers' attorneys even too, but it's not very hard. It's not a very hard concept to understand. If my home price is 500,000, the buyer's going to give the seller 50,000 or some variation, some down payment, and then the seller's going to create a loan for the balance. And then we're going to put the property, safeguard the property in that loan in a title holding trust until that refi eventually happens, at which time the trust terminates. Until then, there's a lot of protections for the seller that they don't realize they have. Because the two biggest objections we get from sellers is number one, what happens if the buyer defaults? Like,
correct.
do I then have to foreclose on them and go through that expensive, lengthy process, which is a no. And then the second question is, well, how long do I have to wait for my money? Because there's a misconception that I only know what a 15-year mortgage looks like, or a 30-year mortgage. Do I have to finance for 30 years? And that's not the case either. And then the third concern or question we get from a seller's perspective is, what happens if I want to buy a house at the same time I sell this house? I need all my proceeds. Well, if you really kind of break it down, a lot of sellers don't need all their equity. They
Correct.
just need enough to cover their down payment on their next purchase. And so those are the three different perspectives that we're really educating sellers on more than anything, is those three biggest concerns. And then you find that in 90% of the case, um, the seller has default protection where they get the house back 60 days without going through the foreclosure process once they understand how we do that. The second thing is how we protect the underlying loan so that in case of a default, it's an automatic process to get the property back. They don't have to pay for foreclosure or go through the legal process or the civil lawsuit process, which is the foreclosure process in Florida anyway. And then they get to see that, oh, I only have to carry this financing for like 2 years, 3 years, 5 years. And then they're going to refinance me out, and I'm going to get the balance of my equity then. And then the third thing, of course, is I really only need X amount for my next home purchase. That means the rest of my equity that's in my house now, I can leave in the property and actually make a nice return on it, right?
So
So
good. So good.
the property doesn't have to be paid off for us to do this kind of financing. The trick is when we structure the loan for the buyer, we just want to be sure that the loan balance for the buyer is bigger than the underlying loan balance.
Right.
And the payment that comes into the seller for that financing they're offering the buyer is a bigger payment than their underlying loan balance.
Right.
So in most cases, our sellers are making cash flow off of their underlying loans. So they're creating this bigger loan payment for a buyer that's coming in than the underlying mortgage payment they have to make on their existing loan. And it creates nice passive cash flow that doesn't require them to pay the taxes, the insurance, the HOA, maintenance on the house, all that's on the buyer. So they get this check every single month. So they're doing what the banks are doing. And the
Right.
banks arbitrage capital. That's all they do, right?
True.
So if a bank can get money at this price and they can put it out there for a loan for somebody to pay this price or interest per month, why can't sellers do that?
Why can't
And
they? I agree.
yeah, exactly. So that's part of Mission 3218 is you have a lot of sellers that don't want to get off the fence. This is why the sales are happening is because that weren't happening before, is you have sellers who don't want to trade in their 3.5% interest rate for a 7% interest rate or a 6.5% interest rate. So what if you could keep your 3.5% interest rate? What if you could take advantage of that cheap capital by doing a loan wrap with a buyer and then making a nice spread and applying that spread to offset your 7% or 6.5% interest rate on your new purchase? Now, essentially, you have a blended rate between the two instead of just disregarding that capital that you have locked up for another 25 years at 3.5%. That's like a gift today.
It is a gift.
Yeah.
And the way you describe it, it sounds like I followed everything you said, which is really cool. I think that's where people get, once you start talking terms and things that they're just not used to or the market, they haven't been trained on, you tend to lose people. But that's what I love about when I hear you speak is that you really bring it to them. You TED it down is what I call it. You,
Sometimes no, sometimes I don't, but I appreciate that. Yeah, at the end of the day, it's so simple when we talk to sellers. It's like, look, do you want to keep your price higher or do you want to keep taking price reductions to find a buyer, right? If you want to be creative on terms, we can cast a much bigger net to bring in the attention of buyers out there and maintain a higher price so you can net more money total. And then if they decide that, yeah, I can do that, and as long as the down payment I structure gives me the cash I need to do the next thing in my life, then okay, that's easy then. Then let's just crunch some numbers. Let's see if recent mortgage statement if the property's not paid off. And then we'll crunch the numbers and show you what that loan could look like for a buyer. And then we just educate the agent on how to update the MLS with those terms. And then all of a sudden, if there's an agent watching this, you never had the experience of taking a property that didn't have owner financing box checked. It just had cash conventional FHA VA. Once you check that owner finance box, watch what happens to showing activity and watch what happens to the response. Now, the downside, once you check owner financing, is you get a lot of shady offers.
I
There's a lot of people out
imagine.
there. Yeah, there's a lot of people out there. Everybody who's listening to this probably knows what subject to offers look like, or they get these weird owner finance offers. But we even help you vet those as well. And
Nice.
then we always counter them based on four different terms that we remember the acronym Dr. BS. Those are the four letters that represent the terms that we counter a lot of these weird creative finance offers so that you can do what's best for your seller. You want me to break those down?
Yes, please. I was waiting
So,
for you to. Yes, actually.
so the number one term that a buyer is going to want to negotiate on, obviously in a way that's in their best interest, is a down payment. Typically, buyers want to come in with as little money down as possible, but then you have more default risk for a seller, of course, because there's not enough skin in the game. It's not painful enough for the buyer if they default, right? So we always typically will counter the down payment for a higher down payment. We always try to stay within 15, 20% or more. And that way, it makes it very painful for a default. If they default, then the way we set these up, there's no foreclosure. Property goes back, control of the property goes back to the seller within 60 days of the default, and they keep that full down payment. So,
Oh,
bigger down payment, the better. The R is the rate. So, a lot of times these buyers want to make an offer with owner financing with a very low rate that the seller can push back for a higher rate. Something that's typically comparable with lenders today, or maybe even slightly better than what they could get at the bank without doing a buy down. That's kind of the sweet spot. So we do a lot of 4.9s and a lot of 5.9s.
nice.
In some cases, if we're buying for cash flow and we make the offer, we'll do it even lower than that. But so then you have the rate. So that's the D and the R, down payment and rate. And then the B is the balloon period. So a buyer obviously wants the seller to keep the financing for 7, 10, even more years than that, where sellers realistically, most of the ones that we do are 5-year balloon payments.
Right.
So, and in some cases, if the buyer, for example, on one we did with just a 1-year balloon, the buyer just wants to sell their house and then they can refi. So they don't need more than a year. In another case, it was an investor who wants to do a refi. They're at their 10 loan limit and they're happy refiing in the next couple of years. So we did a 2-year balloon in that scenario. So it's not always buyers who just can't get a mortgage. It's a lot of times buyers who are overqualified. It's just for convenience. They just go this route, at least in the
Right.
short term. So then we have the balloon period. And then the last S for BS is the structure of the loan. This is the big one. How we structure the deal is important. You don't want to give the deed to the buyer at closing. You want to put the deed in, lockbox it in a safe, in a title protecting trust. And then the buyer gets the deed very similar to a car loan when the loan is paid off or refinanced out later. That's when they get title to the property. Until then, we keep it lockbox in a title holding trust that protects the seller for default protection. It also protects that loan so we don't violate the mortgage contract because you don't want to trigger the due on sale clause
No, you
either.
do not.
Yeah. So, and that obviously is more of a risk for a buyer. So, between lockboxing the property into a trust and then also bringing in a third party servicing company, because you don't want the buyer and the seller to have to interact with each other after the sale either. You don't want the seller having to call the buyer, hey, I don't see a payment, da da da, whatever. So we put a third party servicing company, just like Mr. Cooper or a lot of these loan servicers, that automatically ACH the payment every month from the buyer. If there's an underlying mortgage that the seller left in place, they pay the mortgage payment every month. So the buyer knows that that's being paid. And then if there's any spread left over, that's ACH deposit, direct deposit into the seller's checking account.
Nice.
So you have a third
Dr.
party service.
BS.
Yeah, Dr. BS. We counter the down payment, we counter the rate, we counter the balloon period, and then we counter the structure.
Love it.
And so if an agent knows how to, and if you don't know how to do that, we take you by the hand and look at your offers. So once we check that owner finance box, we look at all the offers that you start to get. And if they're foreign to you, we give you our feedback on them to let you know, okay, this is good or bad, or okay, this is why this isn't something that your seller would want to do. And here's another way that you can counter this offer so that it's safer for your seller.
So how do people learn more?
So the best way to learn is just go to Ted's link, and then they can go through. The first thing we always say is go through training that we do. It's about an hour long, and it breaks down a sample of 7 case studies of recent transactions that we've done, just kind of random case studies, and you'll see why buyers do this, why a buyer would qualify for this, why they would be interested in it, why sellers do this, what the outcomes look like, what those protections look like. It's just a really good training. And it's really geared for the buyer's perspective. But if you're a listing agent and you see a lot of creative finance offers out there and you want to understand how to counter them, you want to understand how to turn those into closings as opposed to just defaulting to a no, then you'll get a lot out of that training as well.
Cool. Yeah, follow my link, which will be below. All right, John, I love it. Mission 3218. I love the whole basis behind it. You have to be creative in this world, and owner financing is definitely one of those ways. I want more people to learn about it so you can talk intelligently about it so you can actually have more options for your clients. And that's really what it's all about, is getting the deal done at the end of the day. And John and his team have it locked. I love it. And because there are a lot of charlatans out there, I'll say it, you don't have to. There's a lot of misinformation and a lot of people trying to or pretending to do what John and the team are doing, but in reality, they don't have all of it locked in like John does. I mean that. So,
I
all right,
appreciate that. And I'll
mission.
tell you
Tell me.
the we'll leave you with this too. I think this is what agents want to know is that there's a body of work out there in the way they do creative structuring on finance, like owner finance transactions, subject to transactions that work for investors, but they don't work in the brokerage community. So if
Right.
you have a fiduciary relationship to protect your buyer and or your seller, we have to wear a regulator hat. So we're regulated by the state. We can't do things that maybe an investor can do on their own with their own purchases. So you're seeing a lot of these creative finance offers that are like one-way streets. They work well for the investor, but they don't work well for our sellers.
Right.
And so if you want to unlock more transactions and get more buyers and sellers off the fence in a time when transactions are slowing and inventory is growing, then knowing how to do safe owner financing that was evolved inside of the brokerage community, because I've been a broker for 30 years now. So when we evolved this model, I'm wearing my broker's hat. I'm not wearing my investor hat. And that's the paradigm shift. So for the people that Ted knows, and then Ted obviously can then be the one to help with phase two of that purchase, which is, hey, at some point, we got to make sure that if you're not mortgage ready, here's the steps we're going to take to get you mortgage ready.
Yes.
And if you are mortgage ready, then I'm going to be by your side so that we can work on this refinance at the end of the balloon period.
Yes. Perfect. Always a joy to have spend time with you, my friend. I really do appreciate it. I'm excited for Mission 3218. I'm excited for this year, and I'm feeling really good about stuff. How about you?
Good, man. Yeah. Could have a lot worse problems than what we're dealing right now.
Amen to
I
that.
say that,
Amen
yeah.
to that. All right,
So it was a pleasure,
guys.
man.
We'll see you soon. Bye, everybody. And then